Welcome to Label on Fire with Label Sternbach, the financial independence and retirement show dedicated to helping you build the life of your dreams as fast as possible with as little stress as possible. Ladies and gentlemen, it's time for Label on Fire.
Hi again, everyone, and welcome to Label on Fire. An incredible episode is awaiting you. And with me right now is Amazon's best-selling author of Living with Financial Anxiety and the book entitled Authenticity. Label, hello, and welcome back to the program.
Hey, how are you doing today?
Doing really well, and I'm just looking across the country as all different weather patterns are happening, and I'm just happy to be in a studio talking with you. So let's talk about the world of crypto. I was looking at Mark Cuban, who owns the Dallas Mavericks basketball team, and he said something about cryptocurrency, and he says, don't invest more than you can afford to lose. So what exactly is happening now in the world of crypto? I've seen some bankruptcies go across and people losing money.
Yeah, as Warren Buffett likes to say, and I love quoting this, a rising tide lifts all ships, but it's only when the tide goes out that you see who is swimming without trunks, right? And that's never been truer than the last few months. People are calling it like the crypto winter or whatever, but basically what happened is, you have highs and you have lows, and everything has to at some point come down. Everything that goes up comes down. And as things came down, what ended up happening is we got to see who was operating on the level, who was taking appropriate risk management, who was being fiscally responsible with the trust that their customers had placed with them, and who just didn't understand what they were doing and were taking on excessive risk. And what I think is important to understand for our listeners who may not know what crypto is or how it all works, this analogy from the guy who just FTX that just crashed, he describes it as this. Imagine you have a box and you decide that this box has value and you give it value, and people see that you give it value, so they put in more money in it. And now people are buying and selling this box that may or may not actually do anything, but they give it value. That's what cryptocurrency is based on. It's that people collectively come together and decided that something had value. Now, ordinarily, if you wanted to buy and sell this box and trade it among each other, right, it's a complicated technical thing. And so these companies have come along over the last few years to facilitate these transactions. They facilitate people buying the boxes and people selling the boxes. Like when you go to TD Ameritrade or the New York Stock Exchange, or you go to your bank, right, all these people are participants in the financial system. And they serve a purpose, right? Either they hold your money or they help you buy and they help you sell. Well, in the US, right, in our normal traditional financial system, everything is regulated. Everyone's got their role to play, and people oversee and make sure that they do what they're supposed to be doing. Crypto is non-regulated, right? It's the Wild West. And so what you end up having is people who are mixing and matching what they do. Some people are taking on the job of TD Ameritrade, and some people are taking on the job of traders, and some people are taking on the job of banks. And it starts becoming a mingle of what exactly they're doing and how they're doing it. But all the average investor knows is they're giving me 16% return on my money. They're giving me like these outrageous returns. So I want to keep getting it, right? And nobody really was looking under the hood of how these things were working. And as the assumptions underlying their business model kind of changed, because it's not always sunshine and rainbows, companies that weren't built to withstand the volatility, they started crashing. What happened in the 80s with the stock market, in the 90s when the dot-com bust, right, in 2000, where you had even more, and you had the housing crash, right? All of that was people made outsized bets on the market based on false assumptions. And when those assumptions came to be realized that they were false, and the market pulled their money or wouldn't take the other side of their transactions, they went bust. Except we're dealing with a very small economy here. We're not dealing with a huge international, dozens of countries, billions of dollars. We're dealing with billions of dollars It is billions, but it's a very small segment of the economy.
We're talking with Leibel Sternbach, and we're talking about crypto. So how is it possible that all of these crypto exchanges are going bankrupt at roughly the same time?
It's what happened with the financial crisis, or maybe a better analogy would be the market crash of the 1920s, where what happened was you had the stock market, people were buying companies and they were investing in them, but nobody had any real insight into what these companies were doing or whether they were valuable. So much so to the point that like a whole bunch of the companies that were listed on the New York Stock Exchange were fictitious. They were just scams set up to take investors' money. And kind of in the crypto world, what you have is you have a lot of that going on where you don't have any transparency. You don't really know what it is that's out there. And then you have companies being built upon this kind of these companies that may or may not exist, these tokens that may or may not exist, and they're trading them and they're making money, and money is changing hands, or this virtual money is changing hands that at some point translates to real money. And what ends up happening is there's interrelated risk. So one company takes an outsized bet, but 5 other companies are part of that bet. And so that first company goes bankrupt. The second company, the other 5 companies, they take a hit on their balance sheet. One of those next 5 companies may not be able to withstand the hit and they go bankrupt. And then the next one goes bankrupt and it becomes a domino. Except there was something else that also happened. It wasn't just financial insolvency. It wasn't just risky trading. What you also have are mismanagement and misappropriation of client funds. So the everyday average investor, they think of traditional finance and they try to translate that to the crypto market, the crypto world, right? They say, I have a bank, and the equivalent of that in the crypto market is wallets and exchanges. And they try to act as if those things are the same thing as they are in the regular market, but they're not regulated. And so what you have is you have institutions, companies that are holding themselves out to be banks. They're holding themselves out to be trading firms or to be exchanges and to have the same kind of protections and safeguards that traditional banks and traditional stock exchanges have, but they didn't put the infrastructure in place to actually have those protections. And in this case, FTX, which just collapsed, it collapsed because they loaned out money to a related party, to a company, the owner of FTX, the majority shareholder, owned a trading company, and then he made a loan to that trading company because that trading company should have gone bust, but he made a loan to them of $10 billion.
Oh my goodness.
Yeah, $10 billion to his own company. But where did that money come from? It came from customer deposits, which is not something that could have happened. It can happen. It's the laws and the regulations are against doing that in the financial markets. And there's oversight and audited financials, none of which exist in crypto. So the way this got discovered was because somebody leaked the balance sheet that was actually months old. And somebody started asking questions that would have been asked in the traditional market that never would have come up because everyone would be looking for it. What happened? Why are these going bust? It's the analogy I like to use is number one, taking on too much risk. Number two, you're dealing with something that fundamentally is it doesn't have any intrinsic value, right? The US dollar is tied to the US economy. It's based on the faith of the United States government, on the people that live in the United States, of our manufacturing capacity, right? People believe in our country as a whole and our government as a whole. And that's very materialistic. There are actual things that you can point to. Whereas, let's say Iran, right? Their currency, right? Nobody cares about their currency. Nobody wants their currency. Or some North Korea, right? You can't use North Korean dollars to do anything. Whatever it is that they use there, right? Nobody cares about it. But in the crypto world, there's hundreds, thousands of these tokens, of these currencies that come into existence, and people give them value. So you had that going on. And then when you add into it the fact that there's just this kind of incestuous, no insight, it's literally you're letting the fox into the hen house And then you're wondering why your money goes missing, right? Why your chickens aren't there the next day. Went there, and that's what happens.
So does this mean that crypto is dying? Will the patient survive? I'll put it.
Yes. So I think this is something that I've been saying for a long time. That at some point something was going to happen. Either it was going to be a government was going to be threatened enough by crypto, or there was going to be a fiasco like this that caused enough people to lose money that would cause governments to start regulating it. So in this case, we have literally, it's thousands, tens of thousands of average Americans. People can own this in their 401k accounts, right? So average Americans, average investors just lost billions of dollars of what should have been secure, right? It should have been low risk. It's things that nobody in their right mind would have thought this is what would have happened to their money. They thought it was safe. They thought it was just in the custody of FTX or in these high yield savings accounts, and they didn't read the fine print. And as a result, they lost all their money, which this is what causes regulation to occur, right? The stock market crashed 1929, right? Stock market crashed. The SEC got created as a result of that because Congress ordered a probe and said a commission, and they investigated and said, come back with what caused the market crash. They came back with a report that said these were the underlying causes. Our recommendation is to create a commission, an agency that will protect the public and will make sure that these things can't happen again. Same thing is going to happen in crypto. There's going to be something, especially when you have so many large investors, institutional investors, people like Kevin O'Leary, BlackRock, Sequoia, right? These are kind of pillars of the financial community. When they got taken in these scams, and it is a scam, right? It was embezzlement. It was every bad word that you can use in finance.
Oh my.
That's what happened, right? They're going to call for regulation or it won't get regulated and there just won't be any more money put into it. But yeah, this is what's going to happen. And I think it's going to, unfortunately, once it starts regulating, it means that everything that has come beforehand, it's probably going to get destroyed. And it's going to be something new moving forward. And this is why it's very hard to pick the winners in the beginning, right? Everything looks like a winner until the winter comes. Yeah.
We're just about out of time, less than a minute or so. But do you have a report or more information that we can get once this program is over?
So if you go on our website, I'm actually putting together a detailed article on, if you want to get the basics of, hey, this is what happened. This is what my outlook is for the future. And this just so you can understand. So when your grandkids come home for the holidays and they're talking about, FTX and SBF and all these guys, right? You know what these words are, you know what's going on, and you know how to protect yourself from when they say, oh, you should go buy Luna or Dogecoin or whatever. You'll have some basic understanding. So go again on our website. That article's coming out. So subscribe to our email list and you'll get
that. Website is yields4u.com. Yields, the number 4, the letter u.com. Now LIBOR is on fire. Thanks for joining us. We'll see you next time.
If you would like to see how the Yields for You team can help you get off the Wall Street roller coaster and save you money on taxes so you can live the life of your dreams, book an appointment online at yields4u.com. That's yields4u.com. Or call 410-914-4894. That's 410-914-4894.
Yields for You is a registered investment advisor in the state of New York and only transacts business in states where the firm is properly registered or is excluded or exempted from registration requirements. Registration as an investment advisor is not an endorsement. Information presented on this program is believed to be factual and up to date, but we do not guarantee its accuracy and it should not be regarded as a complete analysis of the subjects discussed. Discussion should not be construed as an offer to buy or sell or solicitation of any offer to buy or sell the investments mentioned. Annuity guarantees are subject to the claims paying ability of the issuing insurance company. Content should not be viewed as legal or tax advice. Always consult an attorney or tax professional regarding your specific legal or tax situation.